most famously said, which is that there are only two certainties in life: death and taxes. So what are these? What's the realm of possibilities of these errors and omissions? What could they be? Well, unreported income is probably the most common one. Unreported income, a payment made in cash, doesn't get logged on QuickBooks or some other way where the numbers they're not right. There's actually more income than was reported to the Internal Revenue Service, something to that effect. So unreported income, most common, most critical, most often. Another common one: improper deductions, improper credits, improper basis. In other words, the calculation used to measure the gain or loss on a piece of property, whether that be real or personal property. In other words, an example, a tractor that, an improper basis was used to minimize the gain on the sale of that property later. So if it's a very collectible antique John Deere and you just put like a Craigslist price on it, so to minimize the gain on what the actual value of that sale was, that would be an improper basis. Common one is there's a deduction for expenses in the amount of $1,000, but those expenses were actually never paid. The small business never incurred those expenses, or there isn't any substantive receipts, transactions, or any other logs to back up that those expenses were actually incurred, and that would be an improper deduction. These are the kinds of examples where you can have errors, and those errors can create impropriety in the return. And then, of course, there's the other examples of no factual basis to substantiate the expenses, and lack of paperwork, or office security, which is really veterinary and food bills for the dogs that are really family pets. They're not security animals. It's not a security service. These are the kinds of things that can trigger an improper representation on the tax return. So no paperwork, or paperwork that really is a personal expense. So just avoid these pitfalls. There's also an election where an innocent spouse can elect to be essentially given a proportionate amount of tax liability related to whatever they may or may not have contributed. And while that's a confusing concept, where that's critical is when spouses have agreed to live apart, they've either divorced or widowed, or more importantly, they've separated, and there is simply just a complete unknown. Whatever spouse number one is doing is a black hole, and the other spouse, the innocent spouse, really has no knowledge as to how that other spouse is conducting any business. And so the requesting party, that innocent spouse, can ask for some proportionate reduction. If this is the 90% shareholder and there's very, very little of that income being transferred into the community, into the joint spousal community, the spousal home, or if they have separate homes, then that spouse, that requesting party, innocent spouse, can say, hey, IRS, please reduce my responsibility of any liability proportionately because we were separated, had no contact, etc.